If you're a contractor, you may face a more difficult task for getting a mortgage. With contractors, there are 3 ways in which you can be taken on. The first one is through an employed fixed-term contract. The second is through a self-employed day rate contract. And the third is through the construction industry scheme worker.
If you are employed as a contractor, the employer will pay your tax for you. If you are self-employed as a day rate contractor, it is your responsibility to pay your tax at the end of the year. Under the construction industry scheme, it is your responsibility to pay your tax at the end of the year. However, normally tax is deducted at source per month.
If you are a self-employed contractor, you can do that via a limited company, or you may just be a sole trader. You may also be an employed contractor through an umbrella company. With an umbrella company, tax is also deducted from source and normally shown on your payslip. IR35 has also impacted contractors and how they receive their income. If you've changed your trading style from a limited company to an umbrella company, this can have an impact on what lenders that you may be able to approach. Some of those lenders do require you to be trading under that trading style for a certain period of time before they will use your income for affordability on a mortgage.
When assessing your application, the lenders will look at your contract during their assessment. The things that they're looking out for are, they'll be looking at your contract history. So when did you first start contracting? Lenders will want you to have some sort of experience during the contract. Don't worry, if you haven't got any contracting experience at all, potentially there may be lenders available to you, even if you've got no contracting history.
The next thing that they're looking at is the start and the end date of your contract. If the end date is within 3 months, some lenders will require renewal of that contract before they will use that for affordability on your mortgage.
Your contract should also show your payment term. So that could be your hourly rate, that could be your weekly rate, or it could be your daily rate. The common daily rate calculation that a lender will tend to use is they'll take your day rate, they'll times it by 5 days per week, and then they'll times that by 46 weeks per year. The reason why they don't times by 52 weeks per year, they'll consider the other 6 weeks for holiday and sickness. The good news is that lenders can actually use the value of your contract towards affordability as opposed to your sole trader accounts, your tax calculations, or your limited company accounts. You might show as a higher income multiplier by using the value of the contract. If you're an employed contractor, the lender will tend to ask for your pay slips, typically speaking the last 3 months, plus your current contract.
For C.I.S. workers, the lenders will usually look at your pay slips. Some lenders will look at it for a 3-month period and then annualise those pay slips. Some lenders will look at it for 6 months and again annualise those pay slips. Some lenders will want a full 12 months worth of C.I.S. pay slips to determine affordability. It is also possible to find mortgages for contractors even if you've got bad credit. That bad credit may be things such as defaults, CCJs, mispayments, or even bankruptcies. There are definitely lenders out there for you, it's just approaching the right lender. So as you can see, it is possible for contractors to get a mortgage.
For more helpful tips, please check out our next video around getting a mortgage whilst being self-employed.